Hello investors and future investor, welcome back to the channel. In today's video, we've got an intriguing topic that might raise a few eyebrows: how to make money with debt. Now, before you hit that pause button, hear me out. We're not talking about getting buried in loans. We're discussing strategic and informed approaches to leverage debt for financial success. The wealthy use debt all the time to increase their wealth, and so can you. So let me show you how I'm using debt to make more money. Welcome to Investment Gains. Let's jump right into it. Understanding debt. Let's kick things off by understanding what debt really is. Debt is not necessarily a bad thing. It's a tool, and like any tool, its impact depends on how you use it. Whether it's through student loans, mortgages, or business loans, debt has been an integral part of financial growth for many. There are two different types of debt, good and bad. Today's video will focus solely on the use of good debt to make money. I'll show you how I use debt to my advantage to grow my portfolio value. My portfolio consists of real estate, business, and investments. Now let's ask ourselves if we really understand what debt is. Debt in this case is the sum of money that is borrowed for a certain period and is to be returned along with interest. There are two major jargons that's associated with debt, which we will go more into detail later in this video. These are interest rates and credit scores. Leveraging debt for investments. Now that we have gathered a better understanding of debt, let's get into ways how we can leverage debt to make money. We'll explore 3 investment opportunities where taking on debt can yield significant returns. As most of you may know, I make all my videos based on my personal and professional experience, and the list below is the exact strategies that I use to get away from living from paycheck to paycheck. Here are the 3 strategies in which I use debt to make consistent gains, and the first strategy is through real estate. Real estate investments. Real estate is a classic example of leveraging debt for wealth creation. Most individuals choose the path of using a mortgage, which is one way to go if you're already accumulated wealth. However, on my journey to wealth creation, just like most Americans, I also live paycheck to paycheck, so I used another path to get into real estate. My debt strategy is called rental arbitrage. With rental arbitrage, an investor would need to acquire a rental property that can be used for short-term rentals. Using this form of debt is a lot less than a classic mortgage and can be done with just a credit card or a small amount of capital. The general idea is to acquire a rental unit in which you may have to pay the first and last month rent, a few hundreds of dollars for furnishing the property, and then listing that property on short-term rental sites like Airbnb, Vrbo, Expedia, etc. with the landlord's permission, of course. Proceeds from the short-term rental business are then used to pay off the credit card or loan, and then redo the entire process over and again. Now, the classic way of using debt by mortgage is also a very good strategy for those with a long-term outlook. Once a mortgage property is acquired, the individual now has options to generate revenue with that property. One idea would be the use of house hacking. With house hacking, the property owner lives in part of the property and then rents out another part of the property, which generates revenue to help pay down the mortgage. This other part of the rental property can be a spare room, a converted garage for living, or even a spare parking spot. An individual that prefers their privacy or likes the quiet life has another option. This individual can simply pay down the mortgage monthly, and after a certain period of time will have the ability to refinance the property. The proceeds from the refinance can be used as a down payment for acquiring another property, and then it's time to rinse and repeat. Mortgages can be a powerful tool for building a real estate portfolio. There are lots more real estate ventures that can be utilized using debt to make investment gains. Business ventures. The second strategy I utilize debt to make income is through a business venture. As most of you may know, I'm a business consultant specializing in restaurant efficiency and options trading. Now, although I was able to start off my business without using debt, I understand that using debt to get your business venture off the ground is a good idea if you lack the initial capital. All businesses start off with the concept of the going concern, which means that the business is in existence to be financially stable and to continue into the foreseeable future. To start or scale your business, a loan can be acquired by different means. I would recommend borrowing from friends and family if feasible, and then moving on to private equity in the form of funding from private individuals, bank loans, or even crowdfunding. Starting or expanding a business often requires capital, and that capital, although it may come in the form of debt, it can be used to fuel your entrepreneurial dreams and generate profits. Once the business is up and running, the owner generates money from daily operations, which can be used to repay the debt used to start the business. Stock market strategies. The third form of debt that I use to make money is through stock market strategies. Before we continue, I'd like to disclose that there are risks associated with this form of debt, so please consult with a professional before considering this strategy. My favorite form of making money is via the stock market, and most specifically by using options trading. Options trading can boost your portfolio gains in a hurry, and a quick way to electrify those already boosted gains is by using margin trading. With margin trading, a broker lends you additional funds that can be used to make more money, giving you more investment gains. Did you know that most successful investors use margin trading to amplify their returns? The use of margin debt takes discipline and a thorough plan, but with practice and professional help, this form of debt practically pays for itself. We have lots of videos on this channel using options trading, so we won't go in depth. Risks and pitfalls. Now, like everything else in life, of course, it's not all rainbows and unicorns. Managing debt requires discipline and a solid plan. Here are a few strategies to ensure that your debt doesn't spiral out of control. Debt repayment. Always repay your debts. This is critical for creating a repayment history and for trustworthiness. The future of your personal and business finance will depend on your repayment history. A positive repayment history will open doors that most thought was only reserved for the wealthy. One type of repayment method that is extremely popular to reduce debt is using the snowball method for debt consolidation. The snowball method simply means that once one debt is paid off, you can then use the funds that was previously allocated to the debt that was paid off and add that amount to the next debt to be paid off. A couple more payoff methods that may be worth exploring are debt avalanche method or debt consolidation. Debt payoff will also affect your credit score if you're under the American or Canadian systems. A good credit score shows potential lenders how you manage the debts that you were given. Your credit score plays a crucial role in your financial health. Learn tips and tricks to boost your credit score and unlock better borrowing opportunities. Always consider the impact of getting into debt will have on your credit score. There are also important pitfalls associated with leveraging debt to make money that you need to be aware of to ensure a balanced portfolio. Interest rates and economic downturn are two of the most popular factors that affect the use of leveraging debt to make money. Interest rates can fluctuate, impacting your debt's cost. Interest rates will also depend on a couple of factors we mentioned before. Your credit and repayment history will determine the interest rates you will receive and your terms of repayment. Economic downturns are a part of every economy and will happen. So what happens when the economy takes a downturn? The challenges that arise during an economic downturn directly affects your cost of borrowing. Interest rates are not only determined by your credit or repayment history, but also by down economies. On a macro scale, during economic turmoil, governments may increase interest rates, which will affect your cost of borrowing. The direct effect of this will be that investors like yourself will borrow less or be more reluctant to borrow. But despite these challenges, one should carefully consider if the money made from using debt surpasses the cost of borrowing. So in the world of making money with debt, remember, the keys are informed decision-making, not over-leveraging, and most importantly, debt repayment. Debt can be a powerful ally on your journey to financial success if used wisely. If you enjoyed this video, don't forget to hit the like button, subscribe for more content, and share your thoughts in the comments below. And until next time, keep pushing your investments. Thanks for watching, and if you found this video valuable, check out either of these other videos for more insights into investing and options trading.